The state of the world economy today is very interesting. That's certainly one way to put it. Overall economic growth has been moderate, while the stock market and especially real estate have been robust over the past several years. Yet at no time has the mood or the feel of it been brimming with confidence. To understand what is happening, I like to look at another part of history for an apt analogy that can help put the current situation into some perspective. Back in 1914, we had the outbreak of the First World War, but of course at that time, and up until at least 1939, no one called it the First World War. Instead, it was called the Great War, and for a very obvious reason, which was the Second World War had not yet started. Well, it was certainly not mainstream consensus that a second global war would occur in such a relatively short time frame after the end of the first one. In hindsight, historians are able to see that World War I and World War II were not standalone conflicts. They were in fact directly tied to one another in the sense that the First World War left a lot of unfinished business and a legacy through the Treaty of Versailles that steered the world down a path to the outbreak of World War II. In other words, although there were many intervening political and economic developments during the interwar period, the First and Second World Wars could essentially be seen as having been the same conflict, with a 21-year ceasefire in between. Now, moving to today and from the sphere of politics into economics, we actually have a very similar dynamic that is taking place. Back in 2008, the world was hit by a global financial crisis, or GFC for short, and immediately thereafter by what has come to be known as the Great Recession. At the time, there was a lot of fear and speculation about what might be developing. Specifically, there were concerns about another 1930s-style economic depression occurring. But as we know, that didn't develop. What governments and central banks did to avoid such a scenario involved a level of intervention into the economy that was unprecedented in history and somewhat controversial. But many would say that it was well worth it in order to have cured the problem. But did it cure it? Or are we really just in an interlude period, much the same way that society was between the two world wars? The evidence would suggest that this is highly probable, and that GFC and the Great Recession Part 2 lie ahead of us. And that is in fact the perspective here at JAB. Now, if you're not really a detail sort of person and are good with just the bottom line, then take this information and check out my video called The Truth About Protecting Yourself in the Next Financial Crisis for some general thoughts about ways people can mitigate their risk. But if, like most people, you'd like to learn a little bit more about why it is that we're in this mess, then grab another coffee and settle in, because the rest of this video will take about another 20 minutes, but you'll leave it with much better insight into the reality of the current situation. If you've been paying attention to the non-headline business news, the kind of stuff you usually have to dig a little deeper for on the various business news sites, then you will be aware that debt, government debt, corporate debt, and consumer debt, is at historically unprecedented levels across most of the Western world. Debt is the reason that the 2008 financial crisis happened. Debt is the reason that we bounced back from the 2008 crisis, and debt will be the reason we go headlong right into the next crisis. As alluded to at the start of this video with the analogy of the two world wars, all of history is interconnected and nothing happens in complete isolation. So in tracing how the economy got to where it is today, you could go way back, easily to the early 1900s and the creation of the Federal Reserve in the United States. In fact, you could go further back than that. But for a practical understanding, I believe you really just need to start in 1971 when President Nixon announced to the world that the United States would be abandoning the gold standard as the underpinning for the US dollar. The reason they did that fundamentally comes down to the fact that by that time, the banking system had already created so much paper currency and was wanting to create so much more in order to meet government spending programs that they didn't have nearly enough gold to back it all. Now you have to understand that limiting how much currency government could create or allow to be created within the banking system was the whole point of using gold as a backing in the first place. It was a safeguard against creating money out of thin air, which could never be properly valued and would ultimately create all kinds of imbalances. And so in 1971, the US basically announced that they were going to abandon the principles of sound money and embark into a new world of unrestrained, or what I like to call trust me money. That announcement should have caused a global economic panic in itself, but it didn't. And the only explanation for why it did not, sadly, comes down to the complexity of economics and how oblivious the broad population was, and is, when it comes to understanding how the monetary system actually works. You combine that fundamental lack of understanding with the government's spin on the whole thing about how the gold standard was impeding the government's ability to positively manage the economy, and the system more or less just carried on. Now, many people who don't understand this stuff and who are not really students of history of any sort will argue that we've been off the gold standard now for almost 50 years, and despite some recessions, things have held up pretty well. So calling out the decoupling from gold is overreacting. What these people don't appreciate is that yes, 50 years is a fair amount of time relative to a single person's lifespan, but within the context of human history and historical processes, it's a drop in the bucket time-wise. You can bet that by, say, 1933, 15 years after World War I had ended, that few people would have guessed that another war was 6 years away and would be directly related to conditions caused by the first one. But that was the reality. What has been occurring over the past 50 years has been an ongoing game in progress of government, primarily through their central banks, manipulating free market forces to keep the whole system going as smoothly as possible, always with a short-term political cycle outlook. A good analogy would be that the economy under the gold standard was like a slow and steady pack horse. It certainly wasn't ideal in every situation, and you couldn't do anything too fancy with it, like get it sprinting or jumping at will, but it was pretty reliable for the most part. But that wasn't good enough for the government and the central bank. They wanted a faster, more responsive horse, so they opted to get rid of the gold standard and decided instead to take the reins of a bucking bronco that needed continual rider input in order to stay in the saddle. The story of the struggle to stay in that saddle is quite clear to see. After the end of the gold standard in 71, inflation in the US and elsewhere, including Canada, increased dramatically as a result of the delinking from gold. Because it came about due to uncertainty about the value of the now free-floating US dollar and not because of strong economic growth, the new phenomenon of stagflation, which is inflation during a stagnant economy, was seen for the first time. By the early 1980s, it was clear that something had to be done, and so the head of the US Federal Reserve Bank, Paul Volcker, cranked interest rates up to an unprecedented peak, close to 20% in 1981. That did break the inflationary momentum, but it left the weak economy. And this is the point of the story where we get onto the path that heads directly toward where we are today. The early 1980s was the beginning of the Reaganomics era of lower taxation and decreased regulation. These policies definitely helped the US economy, but this was also the decade where credit began to expand significantly, especially consumer credit. All kinds of new credit products were introduced, and falling interest rates made using them more attractive to consumers, and that became a significant factor in juicing the economy. Now, the idea of offering more credit to the public didn't just suddenly dawn on bankers in the early 80s. It was made possible because of the decoupling from the gold standard a decade earlier. I won't get too deeply into it here, but I will explain in a future video how the issuing of credit by banks is the creation of currency. In fact, 95% of all currency that is created into the system comes from bank loans being made, not from government printing presses. But the thing to note is that under the gold standard of currency, credit creation was limited. Without the gold standard, nothing formally limits credit creation, other than government policy and discipline, which, as history has shown, is quite lacking. So after the first couple of years, the 1980s were generally an economic boom period. At the start of the 1990s, the expansion began to fizzle, and there was a recession throughout most of the industrialized world. In response to the contraction, the US dropped its central bank rate below the 5% threshold for the first time in many years. With credit now a bigger part of the economy than ever before, interest rate policy also had an impact like never before, and the new Fed chairman, Alan Greenspan, the maestro as they like to call him, was prepared to play it like never before to keep the credit spending going. Interest rates continued to drop down to 3%, and although the recession in the US had passed by mid-1991, rates didn't move higher again for another 2.5 years. By that point, the economy, and especially the stock market, were booming in the midst of the tech frenzy. To the end of the decade, the Federal Reserve did move rates higher, but always incrementally and always chasing the economy and the market. How it eventually ended, we all know, with the tech wreck in 2000, which of course affected more than just the tech sector. The S&P 500 itself was cut in half from peak to trough, and markets in most other countries, including Canada, looked similar. At the time of the implosion, the US Federal Reserve rate was 6.5%, which was only about average by historical standards. But in that environment where rates had been down around 3 to 4% for several years, 6.5% was enough to burst the bubble. So now it was the start of the 2000s, and again the US, along with most of the world, was in a big recession. So how do you deal with it? Again, the chosen medicine was to cut interest rates and encourage more credit spending. This time, though, the cuts needed to be deeper than the last time, all the way down to just 1%. For the first few years, the commercial economy did pick up, but we didn't see the stock markets rebound strongly at first. Investors had been burned so badly in 2000 that they were still a bit gun-shy, but with all the cheap money sloshing around thanks to Greenspan's policies, it did find its way into investment via real estate, which of course was mirrored in Canada and overseas. Real estate grew into an enormous bubble in the US, and merely a huge one in Canada and other places. And once again, despite this, interest rates rose only modestly, peaking at, again, the historically normal range of 5.25%. As had happened in 2000, that was plenty to blow up the real estate market and take the stock market with it. Another 50% haircut for the S&P, and similar everywhere else. The recession of 1990 was a moderate one. The recession of 2000 was a bad one. And the recession of 2008 was a very bad one. There is a pattern here, and it is not coincidental. Each new post-gold standard recession has been worse than the one before, and there is a reason for that. The reason is because the US dollar decoupling itself from gold, and as the reserve currency de facto decoupling everyone's currency from gold, has allowed government interference into the free market mechanism to an extent never before possible. To recap, specifically this intervention has been in the form of currency and credit creation, which are actually two sides of the same coin. We had a recession in 1990. They fixed it by cutting rates, promoting people spending themselves into debt, and blowing a stock market bubble. That bubble imploded in 2000. Well, they fixed that by cutting rates even lower, promoting people going into even higher debt, and blowing a real estate bubble. That one imploded in 2008. And guess what? They fixed it again by cutting rates to zero, promoting people taking on unprecedented amounts of debt, and blowing both stock and real estate bubbles. Anyone care to guess how they'll attempt to remedy the next recession? The problem is that at some point, you cannot just keep on increasing debt. How many credit cards can a person apply for and max out before it comes back to bite them? Well, this is essentially what is happening at the government level, the corporate level, and on average, also at the consumer level. But governments can't go bankrupt, can they? Surely they can print money if they have to, right? In a sense, yes, and that is where the biggest risk to everyone lies. The government response in the US and elsewhere to another crisis is likely to be very much the same as last time, which means flooding the economy with currency, sweeping bad bank and other corporate debt onto the public ledger, and dropping interest rates back to zero again. In its most simplified sense, all of this means printing money to keep the economy going. That's what it comes down to at the bottom line. The global monetary system is a very complex apparatus that is poorly understood not only by the public but also by most of our political leaders. But almost anyone understands that something does not equate with the notion of printing money out of thin air without consequences. Because if you could do this, why wouldn't governments just simply print all of the money they need rather than tax the population for it? Or for that matter, why not just print all of us $1 million, end world poverty, and call it a day? The reason is that currency itself is worthless if it doesn't represent actual underlying value. If it doesn't represent gold as it once did, or if it doesn't remotely reflect GDP output as it theoretically is supposed to under the current fiat system, then what is it exactly? It's a bunch of colored paper, or in reality, more so, a bunch of blips on a computer screen. The world has shown a lot of faith in the US dollar-led fiat monetary system for the past 50 years, although I think that simple lack of knowledge has had as much to do with it as faith. But it has to be believed that there are limits to how far the abuse of the printing press can be pushed before natural market forces come into play and rebalance the system. The first consequence of inflating the money supply is the inflation of prices for goods and services. Most people understand that relationship, and the government and central banks certainly do. Governments frequently talk about the importance of controlling inflation, but what they don't talk about is how inflation is one way, their preferred way historically, of dealing with the accumulated debt burden. For example, if you owe someone $10,000 today, and next week a massive hyperinflation through the system raises your income by 10 times, that $10,000 debt stays at just $10K and becomes much easier to pay off now that you're earning 10 times as much as you did the week before. The downside to that inflation, however, is one, the prices of all goods and services also go up 10 times, and two, anyone who has saved money sees its real purchasing power drop by 10 times. So it cuts both ways. It's both good to get rid of debt, but really bad for savers. Now, I said that price inflation is the first consequence of massive government money printing. There is a follow-on consequence, and that has to do with the sustainability of a hyperinflating economy. If there's one thing that history has demonstrated clearly, it's that when a hyperinflationary trend takes hold, it is a death spiral for the affected monetary system. It's been seen a number of times over the past century, from post-World War I Weimar Germany to the current example of Venezuela, with many other examples in various countries in between. Now, the fact that Weimar Germany happened a long time ago, which really isn't the case in historical timeframes, or to developing economies like Venezuela, shouldn't give investors a false sense of confidence that it couldn't happen today to major Western economies. As I discussed earlier, the global monetary system today is on a US dollar-based reserve system that initially came into being after World War II because America had most of the world's gold, so everyone's currency was measured against and convertible to US dollars, while the US dollar itself remained backed by gold. The gold backing ended in 1971, and since then the US dollar has remained the reserve currency, but without the accountability to gold. And again, this is known as a fiat monetary system, the word fiat being Latin for by decree, or in other words, the government says it's money, so it's money. While the US dollar reserve system seemed like a pretty good idea when it was first introduced, it's also the Achilles heel of the global monetary system today. The United States is certainly not the only abuser of its finances, but because the dollar is the global reserve currency, problems with the USD will have broadly felt consequences. As the United States continues on its monetary expansion path in an increasingly frenzied attempt to deal with its debt, the true value of the US dollar is going to come under rising scrutiny to a point where it will be rejected in its role as the global reserve. We're already seeing the start of this with some of America's rivals, including Russia and China, who have been decreasing their US dollar holdings and collaborating to work around certain aspects of the dollar-based international trade system. Eventually, Europe will start pulling away from the existing structure as well. And when that happens, the various global currencies will need to rebalance against both the US dollar and one another. In the course of this rebalancing, the US dollar itself would be screwed because it's directly in the crosshairs and would be considered overvalued against almost every other major currency. But in the dismantling of the US buck as the global reserve currency, you're likely to see a revaluation of all currencies as they get recalibrated against some new yardstick. And odds are that results in a loss of purchasing power for most, if not all of them, at least for an interim period of time. And that brings us to one of the most important things that I'm going to say in this video. Investors everywhere need to have a currency risk strategy in place. Everyone is aware that the stock market can be volatile and risky, but because most haven't lived through a currency crisis affecting their own currency, very few people see the risk to their purchasing power, and yet it can be much more devastating than a stock market correction. Worst of all is that it's not just stock market investors who are affected by currency risk. It threatens everyone who holds any asset in currency, including bonds, GICs, savings accounts, and the money under your mattress. As I said earlier, inflation is good for paying off previously accumulated debts, but it also destroys savings. There is a way to help offset currency risk. Investors have been doing it throughout history, but ironically, now that it's needed most, it seems to be nearly invisible, in Western society at least. And that is to hold part of your assets in precious metals, specifically gold and silver. You hear a fair bit of commentary in the mainstream financial media speculating about how gold isn't the store of value it once was, and how it's becoming more and more of a financial curiosity or a relic. The truth is that the role of gold and silver in the monetary system today and throughout history is fascinating and complex, and I do plan on doing another video about this soon. But for now, I'd simply like to say that every sound-minded person on this earth knows what gold and silver are, and that they are valuable. They have been used as a form of money almost since the conception of money, and in a period of turmoil where no one is exactly sure what, if any, value the dollar or the euro or the pound or the yen should have, what do you think will immediately reemerge to be universally accepted as a valuable medium of exchange? Probably something that has done so for centuries through every type of historical event, and that is gold and silver. Note that I am not saying that gold and silver will come back to replace other forms of currency on a permanent basis. What I am saying is that during a crisis period, it will almost certainly be the safe haven alternative to fiat currency. So to summarize, regardless how a superficial look at the current global economic environment may suggest that things are moving along okay and that the financial crisis of 2008 is simply an event for the history books at this point, the truth is that the legacy of the Great Recession is not over. That story is in fact only partway through being written. There are many very good analogies that some astute commentators have made when describing this point in history, and myself have used one of the two world wars with the lull period in between. Another one that illustrates it well is that of the Titanic. The very moment that ship hit the iceberg in April of 1912, the damage was done in an instant, and its fate was sealed. Still, it took almost 3 hours for the ship to sink, and for quite a while, no one except the most connected members of the crew was even aware that there was anything wrong after the initial jolt. In 2008, the global economy hit its iceberg. Central bank intervention since then has kept the economy afloat, but the water is rising, and it's just now getting to the point where people are realizing that their feet are getting wet. Their feet are getting wet when they notice things like the negative response in the stock market when central banks hint at raising interest rates, by the softening in the real estate market, by the rising cost of living, despite governments assuring us that there is no inflation, and by seeing protests in Europe, in part over taxation and growing wealth inequality. And like the Titanic, as it took on more and more water, the pace of this economic sinking can be expected to accelerate. However, that being said, this won't be a linear event. Central banks can be expected to attempt to patch up the holes again, as they did after 2008 with the return to rate cuts and money printing. It won't be as effective as it was the first time around, but it will probably delay the worst of the ultimate correction long enough to give smart investors time currently to get better prepared. As always, this isn't specific investment advice for any individual who is watching, but rather the strong opinion here at JAB for a broad forecast of what lies ahead. So take this as a wake-up call to get serious about doing your homework and, if required, enlisting some help from a qualified advisor who gets it. And do it soon.